So today we are looking at the impact of reconstruction. We are looking at the impact of reconstruction, financial reconstruction on farm value, To be very specific, on the price per share, price per share. And really, the major agenda here is to show you the connection between beta equity and the beta assets, using the �'Hamada's model. Bahati, today why are you putting your video on? Great. Also, Mary has her video on. I don't know why so many guys have their videos on. Please, if there is a day that you should not have your video being on, is today, because of the number of students that we have online. Right? Thanks. Here we are. To be able to demonstrate, like Josephine is saying that she cannot see me. You guys, are you able to see Mwalimu? Are you able to see Mwalimu? So chances are, Josephine, wherever you are, there is a problem with internet. So please, all of us, let us try to ensure that now we join Safaricom. You see, Safaricom has reduced their data. They have reduced their price of their data so significantly. So all of us will be Safaricom people. Ladies and gentlemen, here we are. I would want us to share. Great. Remember the question that we had shared here earlier on, right? It's quite a very interesting topic. Very interesting topic. Just 1 minute, I open my document. Great. So are you able to see my screen, ladies and gentlemen? Are you able to see my screen? It's May 2021. It is May 2021. Question number 4, cow. May 2021. Question number 4, cow. Makazi Limited. And from what I can see, they're telling me, ladies and gentlemen, remember, for company law, we have changed your meeting ID. Please look at your WhatsApp group. This is advanced financial management. Great. So, ladies and gentlemen, here we are. So I'm looking at Makazi Limited. So for Makazi Limited, what do we have here? We are told Makazi Limited, current earnings per share is 6. The farm has in issue 50 million ordinary shares, which have a par value of 20 each. The farm's total revenue and the capital reserves amount to 500 million. The company has an asset beta of 0.9 and a retention ratio of 60%. The management of Makazi Limited intends to undertake a financial reconstruction, which will result in a debt to equity ratio changing from 0.45 to 0.2. Additional information: the risk-free rate is 8%, expected return on market portfolio is 18%, corporation tax rate is 30%. The firm's return on equity before and after the financial reconstruction will remain unchanged. So they want us to evaluate the impact of the financial reconstruction on the firm's share price. So of course, as usual, ladies and gentlemen, we are always used to those situations where we harvest low-hanging fruits. But today, I would want to harvest, in this case here, that fruit which is right at the top. The hardest fruit to harvest here. I would want some good student here to give me the return on equity in this question. They have told us in this particular note that the return on equity is going to be constant between the two periods here, before and after financial what year? Reconstruction. So they want us to basically give them the return on equity. I'm so sure not very many students will be able to get this right. It's among the hardest fruits to pick. Caleb tells me it is, return on equity. To get return on equity, rule. Return on equity, we normally take the profit after tax, the profit which is attributable to who? Ordinary shareholders, all over total equity, all over total equity. Now, ladies and gentlemen, I would want a good student to come and remind us the formula of getting EPS. How do we get EPS? What I've come to learn since I started teaching AFR, there's a big connection between AFR and AFM. Big connection. Doreen, please, your video is on, Doreen. I don't know why, and we have so many guys here struggling with bandwidth. Please always try to put off your videos, right? So I can see Dennis giving me a wrong answer. EPS, earnings per share, will be total earnings over number of shares, isn't it? Right? Will be total earnings over number of shares. Basically, the total earnings in our case here will be the profit after tax all over the number of ordinary shares. All over the number of ordinary shares. So I would want to get profit after tax. I would want to get the profit after tax. I can see another student called Howard putting on her video. So profit after tax. If I want to get profit after tax, I will take the profit per share. This earnings per share is the same as profit per what here, somebody? Per share. This is the same as profit per share. So I'll take the earnings per share times number of ordinary shares. 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 So this is very important, ladies and gentlemen. We are told here, Makazi Limited's current earnings per share is 6. The firm has in issue 50 million ordinary shares, which have a par value of 20 each. Listen, they are telling us that Makazi Limited's EPS is how much? Is 6. And they know the number of ordinary shares are how many? Somebody here, 50 million. So then to get the profit after tax, this one here straight away will be 6 times 50, which will end up giving me how much. My figures are in terms of millions. My figures are in terms of millions. My figures are in terms of millions. Could you kindly give me this thing? 6 times 50 gives me 300 alone. I don't want to put those millions there. So 300 like that. Now, ladies and gentlemen, I would want us to go ahead very fast and ascertain the equity of the organization. Can somebody in this case here help me get the equity? Can somebody help me here get the equity? Equity is quite an easy thing to get. Equity number one, I can see we have got ordinary shares. So I have share capital. And fortunately for share capital, they have given me the power. They have given me, if you look at the share capital here, look at this share capital. Look at the share capital. They have told me the firm has in issue 50 million ordinary shares whose par value is 20. This is quite a good thing. So then I'll take 50 million. I'll take 50 times what here, somebody? So basically I'm taking the par value times the number of ordinary shares, right? Par value times the number of ordinary shares. So what is the par value amount given? 20. Do we know the number of ordinary shares? Number of ordinary shares in the question, there are how many? Knows is the number of ordinary shares. Number of ordinary shares, they are 50. Meaning, ladies and gentlemen, that our share capital here is what here, somebody? Share capital 20 times 50 gives me how much? Gives me how much here? 20 times 50. They're getting 1,000. They're getting 1,000, which is okay, 1,000 like that. Thank you very much. Remember, in the question, they have given us equity reserves. Remember, the reserves belong to equity holders. The reserves belong to equity holders. Reserves belong to equity holders. They have told us that this company has reserves. This company has reserves. If you look at this question, they are telling us the total revenue and the capital reserves amount to how much here? Somebody, they amount to 500. 500. So we have here reserves 500, meaning, ladies and gentlemen, that the total equity here, the total equity will be 1,000. What here? Somebody, 1,500. Will be 1,500. The total equity will be 1,500. So please come here and give us this return on equity. Return on equity, you've just told me it is profit after tax divided by total equity. So could you kindly please help me out here? Kindly, I told you this is quite a tough one, but fortunately, the moment you understand it, everything will become very easy. So we are taking here return on equity. What equity is able to generate is this. So, ladies and gentlemen, here we have our profit after tax. The profit after tax, you guys gave me a figure. How much was this? You guys gave me a figure here. How much was the profit after tax? 300 out of the total equity, which is 1,500, meaning that the return on equity is 0.2, which is the same as what here? Which is the same as 20%. And I'm so sure that all of us would have really harvested this quite a high-hanging fruit. It's quite a high-hanging fruit. It's quite a high-hanging fruit. Return on equity. Unfortunately, they have told us that between the two, before reconstruction and after reconstruction, the return on equity will be the same. Ladies and gentlemen, I want to ask for your permission to rub this. Can I rub this? Can I rub this? Can I rub this? Can I rub this? Great. They're telling me, Mwalimu, go ahead and rub. Great. Now, ladies and gentlemen, after I have gotten that, now I'm going to do a tabular solution. A tabular solution where I will have my matrix here divided into two. We have here before reconstruction, before financial reconstruction, and after financial reconstruction. After financial reconstruction, before financial reconstruction, and after financial reconstruction. Great. Now, ladies and gentlemen, listen and listen to me very well. This is quite a straightforward question. I'll end up getting all the marks without struggling at all. So what have they told us here? They've told us Makazi Limited current EPS is 6. The firm has in issue 50 ordinary shares, which have a par value of 20 each. The firm's total revenue and the capital reserves amount to 500 million. The company has a beta asset of 0.9 and a retention ratio of 60%. And a retention ratio of 60%. Ladies and gentlemen, they are telling us there that the management of Makazi Limited intends to undertake a financial reconstruction, which will result in a debt to equity ratio changing from 0.45 to 0.2. Wow. So they are telling us here that before reconstruction, our debt to equity ratio is equal to what? Before reconstruction, our debt to equity ratio equals what? Somebody talk to me. Before reconstruction, the debt to equity ratio, Moreka anasema ni 0.45. How about after reconstruction, we want to reduce our debt. After reconstruction, our debt to equity ratio changes to what here, somebody? Our debt to equity ratio changes to 0.2. Thank you very much. Great. And then the other thing they have told me is that beta assets, beta assets will not change. Beta assets between the two, beta assets will be the same. Because the beta assets, really we are talking of the beta of that organization that doesn't have debt. Ladies and gentlemen, remember that beta assets is the same as the unlevered beta. If you can remember, beta assets is the same as what here, somebody? Is the same as unlevered beta. is the same as unlevered beta. Umeshaandika namna hiyo mabado. Umeshaandika hivyo mabado. Umeshaandika mahali kwamba this is beta assets, which is the same as unlevered beta. So if it's unlevered beta, it doesn't matter what debt this organization there has. Unlevered beta for both of these scenarios will be 0.9 and point what here somebody 0.9. Great. Ladies and gentlemen, listen and listen to me very well. These guys have given me beta assets, and they are giving me scenarios where we have, ladies and gentlemen, debts. In both of these scenarios, we have debts. Meaning that at the end of the day, I need to convert my beta assets to beta equity. Yes. So I must convert, yes. So convert this beta, convert the beta assets to beta equity. We are saying that convert beta assets to beta equity using who? Using which model? Which model do you normally use to convert? Hamada's model. Using Hamada's model. Using Hamada's model. Using Hamada's model. Now, what I do not know is whether we have got a student here who knows how to write down Hamada's. We have got quite many methods of writing this Hamada's model, but the best is for you to remember that our beta equity over a levered firm will be equal to beta assets into 1 plus debt to equity ratio adjusted for tax like that. This is the easiest formula for you to remember. This is the easiest formula for you to remember, that BEL equals beta assets into 1 plus debt to equity adjusted for taxation. Adjusted for taxation. So, ladies and gentlemen, for this before reconstruction, could you kindly come and give me the BEL? Could you come here and give me the BEL? So remember, beta assets is the same between the two. So beta assets here will be 0.9 into 1 plus. Are you able to see the debt to equity ratio? Are you able to see the debt to equity ratio? Are you able to see the debt to equity ratio? 0.45. It's here. 0.45 multiplied by 0.7. You even haven't seen where I got 0.7 from. You haven't seen where I got 0.7 from. It's because of 1 minus taxation. And the tax rate given here is 30%. So 1 minus 0.3 gives me 0. What here? Somebody gives me 0.7. Gives me 0.7. Gives me 0.7. Thank you very much. Then, ladies and gentlemen, using your body mass, could you slowly come and give me the BEL? Could you slowly come and give me the BEL? So the BEL I'm being given by Josephine Abok as 1.1835. 1.1835. Is there someone else who can confirm that this is correct? 1.1835. And today, I would want each student in this case here to talk to me. So 0.45 divided by 0.2. Where are you getting 0.2 from? No. You know, already this thing it's coming as debt to equity, my brother. The 0.2 is quite a different thing. It's for after reconstruction, after financial reconstruction. Right? Thank you very much. Now, ladies and gentlemen, having gotten now this BEL, I'm at home. And I would want us, when we are at home, I would want us to read the question. I would want us to read this question. Let's read this question again. What we're being told here is to evaluate the impact of the financial reconstruction on the firm's share price. To evaluate the effect of the firm's reconstruction, the firm's financial reconstruction, this debt restructuring, to evaluate the impact of that on the share price. So basically, I need to calculate the old share price vis-a-vis the share price which will prevail after reconstruction like that. Ladies and gentlemen, I would want somebody to come and remind us the formula of getting PO. Is there somebody who can remind us the formula of getting PO? Remember, PO is the current market price per share. The current market price per share. Is there somebody who can remind us the formula of getting PO? This is the easiest thing. PO for me is a provincial officer. This is how I mastered this thing long time ago when I was doing my long time ago when I was doing financial management of section 3 in those old days. Tulikuwa tunasema kwamba PO is provincial officer. That provincial officer will always be equal to district officer, who in this case here will, ladies and gentlemen, be able to rise in form of rank. So it's DO who grows. So DO into 1 plus growth rate. All over, ladies and gentlemen, I wish I can get some of you in this case here mastering this. All over Kenya minus government. All over Kenya minus government. Kenya without a government. Kenya without a government. Kenya without a government. Ladies and gentlemen, please don't take this so seriously. Don't take this so seriously. Today, most of us today, I don't know why, most of us, like Ivamo, why are we putting on our videos today? And today I've got so many people. Why? I will be able to invite all of you guys onto some beauty pageant, some beauty contest for today. It's only Mwalimu who is the most beautiful person. It's only Mwalimu who is the most handsome man who is allowed to put on his video. That's a joke. Great. That's a joke. So next time when we see somebody in this case here putting on their video, we have to penalize them. Why? Because the weather outside here, like at my place, it's raining already. It's raining already. So you don't want issues along the way. Great. Great. Now, ladies and gentlemen, when I look at this formula very well, this is not provincial officer. This is current market price per share. This is current dividend per share. Why current? Because of zero. Current. This is growth rate. This is cost of equity. I don't know whether I've been able to write them somewhere in full, that this is a current MPS, current DPS, and the growth rate. Charity, which county are you in which is so hot? Which county is this? Which county is this? 001. We shall overcome. Now, ladies and gentlemen, with your permission, I know I'm a scholar. I know in advanced financial management, when I start seeing this examiner giving me risk-free rate, when I start seeing him giving me return of the market, when I start seeing him giving me beta equity, for sure I know that he wants me to use CAPM to get cost of equity. He wants me to use CAPM to get cost of equity. D stands for dividend. O stands for what here today? So I'm repeating again. PO stands for current market price per share. DO stands for current dividend per share. KE stands for cost of equity, which we shall get using, in this case here, CAPM, because the examiner has given us a risk-free rate. He has given us returns of the market. We have beta equity there. G stands for growth rate. So please let me know whether I can rub this for me to fix my calculations for PO here on this side, because this side is for before reconstruction. Great. Thank you so much. Great. Great. So they're telling me, Mwalimu, now we have finished doing what here? We have finished doing something very nice here. We have finished writing. Now, Mwalimu, you can rub this. Mwalimu, without fearing. So, then, gentlemen, then I would want you guys to do me a favor. Could you kindly run with this ball and calculate for me the cost of equity before reconstruction? before reconstruction. Please give me the cost of equity here before reconstruction. And remember, we are using CAPM. How do we use CAPM? We know the formula, it's risk-free into ERM minus risk-free multiplied by beta equity of our firm is levered. Beta equity, our firm is levered. So is there somebody who is able to give me the risk-free rate of return? Is there somebody who is able to give me the risk-free rate of return? In this question, somebody, in this question, I would rather project it because there's nobody who is willing to help me. I would rather project the question. The risk-free rate of return is 8%. Risk-free rate of return is 8%. So then I'll talk of 8% here. Is there somebody who is able, ladies and gentlemen, here to see? Is there somebody who is able to see the market returns? The market returns given in note number 2. Shem, thank you very much. It's 18% minus risk-free, which is 8%. How about this BEL, beta equity of a levered firm? How about BEL, beta equity of a levered firm? BEL 1.1835. 1.1835. So could you kindly give me this cost of equity, cost of equity, cost of equity, cost of equity, as per CAPM? They are telling me, ladies and gentlemen, that this is 19,835. 19,835.835%. So this is cost of equity. Now I have got this I have, or I'll be able to get it. This I have, or I'll be able to get it very easily. This now I have, but I don't have the growth rate. Is there somebody who can compute for me the growth rate? Is there somebody who can compute for me the growth rate? Please try computing the growth rate. Growth rate. Try computing the growth rate. Try computing the growth rate. Jamie is asking, why are we using BEL instead of just the normal beta? Remember, the normal beta that we have there is beta assets. And yet in the questionnaire, we need a beta equity of a levered firm. We need beta equity of a levered firm. Jamie, there is a video you haven't watched. There is a video you haven't watched. There is a video you haven't watched. Great. So remember, when it comes to growth rate, there are those formulas that I know you guys must have seen as ladies and gentlemen making use of. Like that formula which talks of n minus 1 root of something over something minus 1. That formula cannot be applicable here. Here, ladies and gentlemen, the formula that we shall use here for growth rate. Thank you very much. I can see already somebody with BR, yes. The formula that we shall use here is the one that talks over growth rate equals B times R, BR. BR, growth rate equals BR, like that, where B stands for retention ratio, B stands for the retention ratio, this stands for the retention ratio, and then R stands for return on equity. So could somebody in this case here give me the retention ratio from this question? From this question, is there anybody who is able to see the retention ratio? Is there anybody who is able to see the retention ratio in this question? Is there anybody who is able to see the retention ratio somewhere up here? The retention ratio is how much? The retention ratio is 60%. Thank you very much. 0.6. And then we have the rule. This rule, fortunately, we calculated it somewhere. We calculated the rule somewhere. Talk about the rule yangapi, somebody somewhere, return on equity. Yeah, 0.2. Thank you very much. 0.2. So meaning that our growth rate here will be 0.2 times 0.6, which will give us what figure, somebody? 0.2 times 0.6, which will give us 0.what here? 12. Thank you, and thank you so much. 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 Great. Thank you. Now, after that, there is only one component that I'm left with. One component that I'm left with. Which component is that? The DO, the current dividend per share. The DO. Please go ahead and give me the current dividend per share. Let me now remain quiet a little bit. Let me remain quiet a little bit. Is there somebody who will be able to give me the DO, the current dividend per share? Current dividend per share. Let me see whether there is anybody who will be able to give me the current dividend per share. Just a minute. Let me see whether there is anybody who shall be able to give me that figure. Let me see whether there is anybody who shall be able to give me this figure called the DO. Nobody is talking to me. Nobody is talking to me. Nobody is talking to me. 2.4. Correct. Correct. Tala Arnoor. Mesh keep 2.4. Yes. 2.4. Yes. 2.4. Yes. Now, ladies and gentlemen, here we are. Listen and listen to me very well. You see, you are the people who told me that Mwalimu, the retention ratio is 60%. If retention ratio is 60%, then we can easily get to what we call the dividend payout ratio. So if the retention ratio is 60%, we're retaining 60%, then what percentage are we paying out there? 0.4, 40%. So basically, for us to be able to get this current dividend, what we shall do is to take 40%, the dividend payout ratio, we multiply this with the current EPS. The current EPS. So like each share is earning 6 shillings. Each share, we were told in the question, we were told in the question, we were told in the question, we were told in this question, we were told in this question, ladies and gentlemen, we were told in this question here that each share here has a current EPS of what here? Of 6. So out of this current EPS of 6, some of this amount will be retained back in the company for purpose of funding or future growth. That's why we're getting G using the BR. And ladies and gentlemen, 40% will be paid out. So the payout ratio is 40%. So then my DO will be 40% multiplied by the current EPS, which is 6. That is how those students who are getting 2.4, that's what they were doing. That's what they did to get the 2.4. So are we together up to there? I'm driving at something very important. I would want students to thank me after their exams. You know, 2 things here. Either some of you will come with big stones, looking for me all over. And then most of you, of course, will be coming and saying, Mwalimu, you taught us very few things, but you helped us. You helped us. You helped us. So Sasiet wants me to repeat the formula. Basically is here. How do we get current dividends? We'll take the dividend payout ratio times the current EPS. And this examiner has told us up there that this company is a serious company which is looking at funding its future growth in a big way. In a big way. They are retaining 60%. So if they retain 60%, then what percentage are they paying out there? If they retain 60%, what percentage are they paying out there? Yeah, 40%. 40%. That's why we took 40% of our current EPS. That is it. That is it. Now we have everything. Please come and plug in here for you to give us what here, somebody? The PO before reconstruction. The PO before reconstruction. So our PO before reconstruction, how is it going to look like? How will this look like? So PO before reconstruction. So do we have our DO? Yes, we do. Our DO is 2.4. Do we have the growth rate? Is there somebody who can remind us what growth rate we got? Is there somebody who can remind us what growth rate we got? It was 0.12. Thank you very much. All over cost of equity. Is there somebody who can remind us what the cost of equity was? Cost of equity. Cost of equity. Cost of equity. No. Cost of equity must always be given as point something. Point. Don't never put the form of, you'll go wrong. Cost of equity must be point something. So it will be 0.19, minus growth rate of 0.12. So could you kindly go slowly, get the numerator, go slowly, get the denominator, and then you do what you divide. Is there somebody who can give us what the denominator is? 2.4 times, open bracket, 1.12. Please give me the numerator here. 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 So somebody is giving me a figure of 2.688. 2.688 all over the denominator. Denominator, please take this minus this. Give me a figure I write here. Give me a figure I write here. 0.0784. 0.0784. Like that. Then what is the quotient? What is the quotient? What is the quotient? This divided by this? 34.31. So this is the market price of a share, 34.31. But now remember that this is the market price per share before what? Before reconstruction. When we use this old debt to equity ratio of 0.45, how about the PO, but this time round after reconstruction? After reconstruction, so I would want to move now very slowly here for my students to be able to pick now the entire picture. For my students to be able to pick the entire picture. So I would want, in this case, ladies and gentlemen, all of us to calculate, in this case here, after reconstruction, what will happen here. The good thing is that the processes, the steps are quite repetitive. The steps are quite repetitive. Can I rub this? Can I rub this? Can I rub this? Thank you very much. Thank you very much. So the steps here are quite repetitive. The first thing, when I open my eyes like this, what I'm able to see is this BA. This BA is a bad thing. For us in finance, we know whenever we see beta assets, not unless we are told, ladies and gentlemen, that the company does not have any debt at all. So long as it has got some form of debt. Like now here, ladies and gentlemen, it has some form of debt. It has got some form of debt. Maybe to help Ivamo, what you do, just take a solution and send her on WhatsApp. I think that will be able to help her out, right? So ladies and gentlemen, look at this. When I see these beta assets, I know there is a problem, but I know that for me to be able to untwist myself out of this problem, I know I'll have to apply Hamada's model. And Hamada's model, you are the ones who have told me that BEL equals bar into 1 plus D over E, adjusted for taxation, right? So then my beta equity over a firm that is levered, beta equity of a firm that is levered will be equal to beta asset. Beta asset is the same across board, which is 0.9 into 1 plus. Do we have this debt to equity? Do we have debt to equity? Do we have debt to equity? Do we have debt to equity? It is 0.2 what here, somebody? 0.2. And then these has to be adjusted for these tax. Remember, it is 0.2 multiplied by 1 minus tax. The tax rate was provided as 30%, 0.3. So then 1 minus 0.3 gives me 0.2 what here? Gives me 0.7 like that. Gives me 0.7 like that. Which at the end of the day will give me, I'm being told here by some good lady called Mary, also Charity, it is 1.026 like that. And then I would want us to have the same number of decimal places. To avoid those inconsistencies in terms of answers, let's have the same number of decimal places. Like the teacher, like now I have here 1.026. If you've got like 1.0263 more 3, Ibakivo. Now, could you kindly talk to me tonight? Having gotten this BEL, having in this case, ladies and gentlemen, BEL, in this case here, having gotten this BEL, ladies and gentlemen, could you kindly tell me what is the next thing that I should do? Please talk to me. Tell me the next thing that I should do. Thank you very much. They're telling me, Mwalimu, this is quite easy. Get cost of equity using CAPM. Get cost of equity using CAPM. So how do I get cost of equity using CAPM? I know the formula. It is risk-free plus expected returns of the market minus risk-free multiplied by, it has got to be multiplied by BEL now. They are multiplied by BEL, multiplied by beta equity over a levered organization, multiplied by beta equity over a levered organization. The organization that we have here is levered. Ladies and gentlemen, I would want to come back to you. Are you able to see the risk-free rate of return? Are you able to see the risk-free rate of return? Bet tells me, yes, Mwalimu, it is 8%. Thank you very much. How about market returns? How about market returns? 18%. 18% minus risk-free again, which is 8%. multiplied by the Bell thing that you guys got, which is 1.026. Could you kindly give me the final answer now? Could you kindly give me the final answer? The final answer. The final answer. I'm being told it is 18.26. So all of us are writing there 18.26. And for purpose of my substitution in the formula, I know this will be 0.1826. 0.18. This one I know will be 0.1826. So are we together up to there? 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 Great. 8, 2, 6. Great. Now then, if that is the case, could you kindly then again guide me? What do you think will be the next step, having gotten this cost of equity? Yeah. The growth rate, I'll not compute the growth rate at all. Why will I not compute the growth rate, Rosie? Rosie, it's because here we were told that whatever growth rate you got, look at this. The firm return on equity before and after the financial reconstruction will remain what year? Will remain unchanged. And remember, if ROE is remaining unchanged and retention ratio is 60% remaining unchanged, really, the growth rate will not keep on changing. The growth rate will not change. The growth rate will not change. Growth rate will not change. So in this case here, what you're telling me, Mwalimu, is straight away come here and compute what here? Compute your PO. Mwalimu, go ahead and compute your PO. Go ahead and compute your PO. So my PO after financial reconstruction, remember the formula still stands. It's DO into 1 plus growth rate all over KE minus growth rate. All right. So PO, there is nowhere where they have told us, ladies and gentlemen, that our EPS is going to change after reconstruction. If you get a very good examiner like myself, I have to introduce a few things there. I would have said because of this financial reconstruction, because of debt going down a little bit, EPS will go up by 10%. If I was the one setting, yes, I would have introduced something small there. But you're lucky because I'm not an examiner, right? So the DO still remains the same. So the DO is what amount, somebody at DO? Can somebody remind us? DO is what amount? DO is what amount? It's 2.4 into 1 plus growth rate. What is the growth rate? What is the growth rate? What is the growth rate? 0.12. All over cost of equity, we wrote the cost of equity here. Was it 0.18? Please remind us, 0.18. 0.1826 minus the 0.12. Please go ahead and give us the numerator. Go ahead and give us the numerator. Just give us the numerator alone. Give us the numerator alone. Give us the numerator alone. Somebody is telling me it is 2.688. 2.688. 2.688 divided by the denominator. Denominator is 0.1826, 0.0626. 0.06. So all of us, let's have this in terms of the same decimal places. So when you divide, give us the quotient, what are you able to get there? What is the final answer? 42 point what here, somebody? 42.94. So then what do you think of this financial reconstruction? Is it good or bad? Look at the old market price per share before reconstruction. Compare it with the current market price per share. Ladies and gentlemen, every organization would want to maximize their market price per share. They would want market price per share increasing. So in this case here, we are saying there that the market price per share has increased, meaning that the financial reconstruction is good, meaning that the financial reconstruction is what here? The financial reconstruction is good, is recommended. Is recommended. Is recommended. The financial reconstruction is what here? Is recommended. Is recommended. So have you understood that question very well, or would you want me to repeat it? Have you understood that question very well? At your own time, if you get a chance, ladies and gentlemen, of reviewing it, do you think you'll be able to master it? Do you think you'll be able to master this? All right. So for those new students, because I am so sure that there are very many new students here today, many new students here today, I would want to welcome all of you to RCM Online College. Come next semester, this should be your college of choice. This thing of running helter-skelter from wherever, looking for physical classes, that thing is long gone, right? Here, these students we have been with here, they'll tell you it's quite a very convenient model where we study here, live Zoom, and then of course we share videos with them. They're able to make references here and there. So please, should you want to talk to us, this is our number. And if you want to see even these students that I have currently here, if for example, you want money markets videos, where do you get them? You go to my YouTube channel, my personal YouTube channel, you'll get them. So you go there, Joshua Aura, search for Joshua Aura Money Market, you'll get my videos there, watch them. But unfortunately, these students, again, after watching, they forget to subscribe. They forget always to even make a comment there. I mean, I'm teaching very mean students. Otherwise, thank you very much. If you've understood this question, Leo, we do another question. No, I'll not do another question. Why? Because you guys have got very many videos touching on this beta equity of a levered organization. You guys have many questions touching on this. Right? On this Hamada, yes. I would request that first of all, if we could get somebody like Stephen Guga knows where we keep these videos. If you can just check out like 2 of them that have got this Hamada concept, please share them with these students here. If you'll be having a problem after you've watched, then you can create time to really do other examples. Otherwise, I would want to go to something quite different, very interesting, something quite different, very interesting. Are we ready for an interesting session?